So when we think about our asset mix recommendation for a global balanced investor, we're always taking into consideration the short-term challenges as well as the long-term opportunities. Of course, there's always things to be worried about in the near term. At the moment, it's the war in Iran. There's concerns around AI or its durability of the AI theme, or whether or not that will ultimately fulfill the high expectations that investors have. But we also want to recognize that as we look far into the future, challenges are likely to be overcome. Economies are likely to continue to grow, corporate profits continue to rise, and stocks are likely to continue higher. And so how do we navigate this in the short term? Well, our base case scenario is for economies to continue to grow. Of course, the Middle East conflict does put a dampener on things in terms of the growth perspective, but not enough to cause recession in our view. Perhaps it causes a little bit higher inflation. We think that effect is likely to be temporary. And so we think that the increase in bond yields that we've seen over the past quarter is an opportunity to add a little bit to our fixed income exposure. In fact, we were underweight fixed income going into the quarter. And so we took advantage of the higher yields to narrow our underweight exposure in fixed income. We added 50 basis points to bonds sourced from cash. We still have a little underweight, but it's smaller than it was a quarter ago. We continue to think that stocks are going to outperform bonds here over the next year as our base case scenario. But we recognize that valuations are quite elevated and that equity risk premium, so the premium between stocks and bonds, is historically narrow. And so we don't think that this is an environment where we want to be taking excessive risk within our asset allocation. So we have a small overweight in stocks, 1% above our strategic neutral. We think that situates us well to take advantage of volatility should it arise. We have made some changes regionally within our equity allocation, though. We have neutralized our overweight exposure to emerging markets. We recognize there's been a tremendously strong run in emerging market equities. A lot of that was driven by semiconductor stocks in a very concentrated move. We decided to reduce that exposure from a small overweight to neutral. We reduced our European overweight exposure to an underweight position, so a slight overweight to a slight underweight, recognizing that the challenges with respect to the war in Iran are likely to hinder the European economy slightly more than the global economy. And then we shifted those proceeds to the US. And so whereas we had a slight underweight in the US exposure to US equities last quarter, we now have a slight overweight. And so we're comfortable with all these positions, fairly close to a neutral asset allocation with a slight tilt toward equities, positioning us well to continue to benefit from the tailwinds that exist around the artificial intelligence build out and all of those tailwinds associated with that, while at the same time being responsibly allocated and giving us the ability to sort of weather any sort of volatility should it arise.